Okay, let's jump right into this explainer. Today, we're going to investigate the underlying realities of the fiat financial system to figure out what, if anything, truly holds value. We spend our whole lives working, saving, hustling, and investing, but how often do we actually stop and look at the foundation of it all? Well, we're doing exactly that today. We're going to break down the literal mechanics of the assets we trust with our financial futures. But before we can really answer whether these popular investment instruments are truly valuable on their own, we've got to peel back a few layers. Why do we chase these investments in the first place? Like, why is there this constant, unrelenting pressure to park our capital into all these different vehicles? Well, the answer actually lies in the environment we're forced to operate in. Let's start with Section 1, the inflation trap. It all begins with a pretty massive systemic problem. Governments can basically print money out of thin air with absolutely zero hard backing. Nada. This creates what we call continuous inflation. And hey, this isn't just some abstract, boring economic concept. It is the continuous, everyday risk of your money losing its value simply because the total supply of money keeps expanding. Because the purchasing power of your cash is just constantly bleeding out, you are virtually forced to find ways to make your money grow just to survive the trap and maintain your normal standard of living. Which leads us to Section 2, chasing scarce assets. So to protect our hard-earned purchasing power from just melting away, we instinctively run toward things that seem to have a restricted supply, right? Things that can't just be printed on a whim. Over time, people have flooded into very specific vehicles, rare earth materials, real estate, stocks, commodities, and collectibles like fine art. We naturally assume they are scarce. But what's the actual risk hiding behind each one of these? And why are some so much more volatile than others? That brings us to Section 3, the precious metals dilemma. Let's kick off our investigation with the oldest safe havens in the book, gold and silver. For centuries, these have been the definitive answer to the inflation trap, and honestly, they're considered lower-risk assets for a very good reason. Their supply is naturally limited by the earth itself. Unlike fiat currencies, they absolutely cannot be created infinitely by some quick political decision. Plus, they aren't just sitting in dusty vaults or being worn as jewelry. They have a massive range of real-world industrial applications, so they have genuine, baked-in demand beyond just simple speculation. But trying to invest in them presents a pretty major dilemma. Here is the heart of that dilemma. Holding physical gold brings, well, physical limitations. You've got to deal with storage headaches, transportation nightmares, and obviously some major security risks. On the flip side, you could go the easy route with paper ETFs, but that introduces transparency issues and management costs. And over long periods of time, even tiny management fees can quietly eat away a really meaningful chunk of your returns. It's like a slow leak in a tire. Moving right along, let's look at Section 4, stocks, bonds, and debt. As we transition away from metals and dive into the main pillars of the fiat financial world, traditional finance is basically built around three slices of the pie: cash and cash equivalents, bonds, and equities. I mean, this is the standard retirement portfolio we've all been sold. But if we look just a little deeper at bonds and stocks, they are masking a pretty surprising reality. Fundamentally, both of them can actually be classified as debt. Now, with bonds, the structure is totally obvious. They are simply debt. You literally lend your money to a government or a corporation, and in return, they promise to pay it back later with a little bit of interest. Simple, right? But it means your investment is only as safe as the creditworthiness of whoever you lent it to. But wait, what about stocks? Most of us genuinely believe that when we buy a stock, we truly own a piece of that company. We feel like part owners of the business. But technically speaking, that's an illusion. It's not entirely accurate. Think about it this way. If a company goes bankrupt, there is a very strict hierarchy of claims. Step 1, the absolute strongest claim belongs to the debt holders. They get paid first. Step 2, way at the back of the line with the absolute weakest claim, common shareholders, you. In reality, stocks kind of act as a Trojan horse for a debt-based structure. When you buy equities, yes, you're providing capital so the company can grow, and if they succeed, you can sell your shares for more. But make no mistake, you are participating in a structure where you have the absolute weakest claim on assets if things go south. And because you carry the highest level of risk when companies inevitably fail, whether that's from poor management, fierce competition, weak execution, or just rapidly changing markets, you naturally expect higher long-term returns. That's exactly why equities are expected to outperform other assets. But as we all know, not every company succeeds, which means not every company is actually worthy of your investment. Which brings us to our final section, Section 5, the illusion of scarcity. This is the ultimate verdict on our traditional financial landscape. We started this explainer looking for scarce assets to escape continuous inflation, right? But did we actually find them? The absolute crucial point here is this. Since these instruments are ultimately issued by governments and corporations, their supply is not truly limited at all. Governments can just issue more debt whenever they feel like it. Companies can just print and issue more shares. So that scarcity you thought you were buying into to protect your purchasing power, in many ways, it's just an illusion. So here is the bottom line. Whenever supply can be continuously expanded, whether it's the fiat currency sitting in your checking account, the bonds issued by your government, or the shares issued by a massive corporation, you have to eventually ask yourself one fundamental question. How much real value actually exists behind the asset you're holding? Think about it. If the entity you trust can just create more of what you own out of thin air, are you truly protecting your wealth? Or are you just holding a different flavor of fiat?